Tom Michaud, CEO of KBW, a Stifel company. So, Tom, what do you expect?
Good morning, Sarah. Well, like you said, we've just had 2 years of down earnings per share, and we think the banking industry is turning the corner on a variety of fronts. One is we think we're embarking on a 2-year growth cycle. The biggest banks we think are going to grow earnings 15% this year. So that's because the yield curve is no longer inverted, and it's because we're getting a little bit more loan growth. We also think that there's a positive coming on the side of regulation, which could have a material impact on the biggest banks and on other banks. And having just less intensity like we've had it, we think could be a bullish case for the banks. So many of the banks still trade at a discount to the overall market. Right after the election, the stocks went up 11% the first day. They've given all that back. We know there's a lot of concern right now about higher for longer in rates, and that's causing us to maybe narrow our stock selection some as we go into this earnings reporting season.
So how do you think about winners and losers now that we have seen this big rate move?
So number one is asset-sensitive banks. So I think the way to think about it, Sarah, is the underlying trends are positive for the industry. The banks that are best positioned are the ones who are asset-sensitive. So we like State Street, for example, and the bigger banks tend to be more asset-sensitive. We also think this investment banking cycle is gearing up. We've got 25% growth for investment banking revenues this year and 15% growth for trading in our large cap estimates. And if the Basel proposal does get walked back some, there could be more capital return. It actually would cause Citigroup's earnings per share to go up by 18% if there was an entire non-increase in the Basel proposal. So we think these are some bullish factors that can support especially the biggest banks.
Tom, how much are you thinking about, you mentioned State Street, we'll get their numbers on Friday, but the regionals and the community banks, how much should we be thinking about a potential for an echo of what we got in the spring of 23?
Well, so I think, well, first of all, the spring of 23 was quite extraordinary.
Exactly.
I think that had to do with the significant change in rates and how much bond buying the banks had done during COVID. So that has been better managed. And I think it would take rates to go a lot higher. There'd have to be a pretty significant shock for more pressure to come there. I think with the smaller banks, they don't have the non-interest income resources in investment banking, so their earnings per share is going to be less robust. We think they're going to grow earnings at 6%, even though there are several banks that we think will benefit from possibly better or more tailoring for them in the regulation side. So we think that on a stock-selected basis, this current rate worry is an opportunity to selectively buy some of the stocks that have now round-tripped the Trump bump. So that's how we've been proceeding.
Hey, Tom, it's not as though we're not coming off a really strong year, though, for so many of the big-cap banks. I mean, they outperformed the S&P by a good margin last year. Do you expect that will be the case in 2025 as well?
David, unfortunately, that's a reflection of how poorly they did the year before. So even though they had a big percentage move, my experience is when the earnings profile for a company is improving, their earnings per share is growing, gives them a chance to raise dividends, gives them a chance to build their balance sheet. There's also a real capital growth story in the banking industry right now, which I think is very positive. I have found over my career that that's a good environment for the stocks. Mm-hmm. But I think you're right. I've talked before in your show about there being coiled springs. I wouldn't call the sector as a coiled spring, but I do think there is upside. And really the best judgment for investors to make is this current rate worry worth what's happened to the stocks? Because there's a lot of rate worry in these stocks at the moment. But let me say one other thing, though, to be cautious. You've heard me say this before in your show. The biggest torpedo in the ocean is always credit quality. If rates were to go up so high that it would reignite a conversation about credit quality, I do think that would give investors pause. Our channel checks don't show anything like that happening now. I do think there'll be one-offs this quarter, but we're still coming off a low basis. So I think that's balance.